One. Welcome everybody to another show of Smart Money Circle. With me today is a very special guest, David Grumhaus, who's president and CIO of Duff Phelps Investment Management Company, and with approximately 12 billion in assets under management. David, welcome to the show. Thank you, Adam. Great to be here. I always like to begin, David. Can you give us a little background about your story and how you got to where you are today?
Sure. Grew up in the Chicago area. Growing up, I loved math. I loved finance, loved the markets. That led to me for a career in investment banking. Spent 11 years in investment banking with split between Goldman Sachs and William Blair. And then I made the jump to the buy side. I went to go work for a utility and energy focused hedge fund here in Chicago. I spent 10 years doing that and then joined Duff about 8 years ago.
Oh, wonderful. And tell us a little about Duff & Phelps Investment Management, which I know is different than Kroll and the other Duff & Phelps, but please let us know.
Right. So, Duff & Phelps Investment Management, Duff & Phelps has been around for 90 years. Founded in 1932 is basically a utility research firm. We started managing money in the late 70s. We're, as you mentioned, we're about $12 billion in assets, mostly equities, and mostly focused on real assets. So areas like real estate, global listed infrastructure, including midstream energy, utilities, communications, and transport assets. So that's really where we're focusing most of our time.
Wonderful. And your investment process, can you speak about that a little bit, break that apart for our audience?
Sure, I'd be happy to. Our investment process, as I said, we're absolutely real asset focused, and we really see ourselves as sector specialists, relying on deep fundamental research in those sectors where we're active. We study the companies, we study the industries, we learn the trends, we really try and build deep relationships with the management teams, and we really are dealing with largely a set universe of stocks. So we really get to know those stocks and understand the trading patterns of those stocks. And, we try and gain a competitive advantage versus others in those sectors. So I think that's really the process that we use. We have different strategies headed by PMs with a number of analysts under each of them. And again, really try and make money that way.
I love it. So you're fundamental based. Do you incorporate technicals at all? Because I know a lot of the audience always asks about that.
It's interesting about technicals is, we don't formally use technicals in our work, but I'm a big believer in technicals. I always, I would say to investors, both institutional and even, retail investors, that technicals can definitely be your friend. I think when you first start in a career, you sort of think technicals, if you're a fundamental analyst, you sort of say that they don't work and it's hodgepodge, but then you watch trading patterns and you watch how the technicals work. And I really do feel like that they can provide an advantage when trying to figure out how to buy and sell stocks. And it's something that I work hard with our PMs on. I mean, I really try and look at charts and say, the chart would say this is a decision point, right? You should be buying or selling, right? And look, do they always work? And no, but I think they can be used to your advantage, and it is something that I'm a believer in.
Yeah, I just published a new book. It's called Psychological Analysis, which is a third school of thought. And the idea, nothing works 100%. And I agree with what you're saying 100% here. How do you handle a situation, David, where you have the technicals going one way, the fundamentals might be going another way? And then it's going to lead me to my next question about risk management. But what do you do when there's cross currents where the fundamentals are leaning maybe yes and the technicals are saying no, or vice versa?
Right. As I always say with the technical, at core, we're fundamental analysts, right? So I think that probably wins in the long run. But, what I will always say to my PMs or say to the analysts is, be respectful of the technicals, right? That if something's breaking through a technical or if something's on support, it's probably a decision, and maybe you should, lighten or maybe add, depending on where the technical is. I'll send charts to PMs for names that I know they like fundamentally, and I'll see the technical and I'll be like, I know you like this. You might want to think about whether this is a place to buy it or to add to it, right? And so I think they can really work together. You're right, you are going to get cross currents, and I wouldn't necessarily say to, I never say to our PMs, you have to sell this, right? That's not the way we work. but I will use it as a reminder and just an observation that, it probably makes sense to be thinking about what you want to do here.
I love that. And then some of the other larger money managers like yourself that I speak to, they look at the fundamentals and they look at the technicals, and then they actually help build bases where they defend support, or they look the right side of the base on the way up. Do you do that as well, or how does that come into play?
Yeah, I mean, I think we do that. We certainly keep it in mind. I think when we buy positions, right, you can trade around positions, and look, we're a low turnover shop. We're not, very different from my hedge fund days where we were very active on the trading front. But I always say to do it both myself and say to my team is, be looking for ways to add, right? Establish an initial position that you think is the right position, right? If that thing starts to go against you, your instinct should be to want to add to it unless something has changed, right? If you had the conviction to go into it, right? At the same time, the other way, if you've got a position and it's working really well, and it's hitting a ceiling or hitting a technical, maybe you take some of it down, right? And sort of see where it goes and let the technical get confirmed before you make the position bigger. So I think they can work together.
Of that. So the segue to my next question is, how do you handle risk, and what mistakes do you see people make with respect to risk management?
Yeah, risk is obviously incredibly important. And as CIO, it's taken on an even greater role for me because obviously I'm looking over a lot of different strategies. I think as an institution, at the heart of risk is, are we following the laws, which hopefully we obviously are? And second, are we complying with our mandates, right? Every one of our strategies has a mandate, and you need to stay within that mandate. So that's sort of the big picture risk. But when I spend time with the PMs and I sit down with each of the different PMs every month to sort of go through the strategies and performance and talk about what they're seeing and what I'm seeing, I think the first thing we try and understand is, what are the bets we are making? So, what are the big overweights? What are the big underweights relative to benchmarks? If that's what we're tracking, where do we have exposures? Whether it's geographic, whether it's subsector, whether it's thematic. You want to make sure that exactly, you should have a good idea as a manager based on what goes on in the market about how your portfolio is doing, because you should know where those exposures are. We look at factor exposures as well. I think those can be helpful. I will say in sector focused funds that we operate, they tend to be a little less helpful, right? If you're running a purely S&P 500 growth strategy and you're across the 11 different S&P 500 sectors, right? Those factors really can matter, right? If I'm running a midstream energy sector, all the stocks are fairly correlated to the same factors. So it's a little bit less helpful, but you can definitely look at the factors, especially with some of the funds that are, like a global infrastructure, which has got, some fairly different subsectors in it, and learn stuff from it. So I think keeping an eye on that, all of that is important.
Wonderful. And then let's go back to the fundamentals for a second, because I'm really curious on how you actually go about the selection, or the PMs go about the selection. Can you speak to that a little bit? Do you look for a certain, is it price to book? Is it price to sales? Is it valuation, PE? Or how do you find that's the idea, this selection process?
Yeah, and I think it'll vary a little bit whether, if you were talking about our global REIT portfolio, they're one way. And if you're looking at infrastructure, utilities trade different than midstream. So it does depend a little bit, but I think it's a combination of, certainly valuation and relative valuation versus other stuff in the sector. Okay. And then I think it's understanding the story and the management teams and just sort of trying to rank accordingly, if you will. We start, as I said, because we're in these sectors, we have a pretty fixed universe. Mm-hmm. So we'll start with this universe that we think fit the mandate that we're talking about. And then we'll develop sort of a focus list of, if the universe is a couple hundred names, maybe we have a focus list that's got, 80 or 100 names on it. And then from that, we're going to sort of pick the portfolio of, 30 to 60 names, again, depending on which strategy we're talking about. And I think when you're going from that focus list down to what's in the portfolio and how you weight that portfolio, I think it's a combination of conviction. I think it's a combination of valuation. Certainly things like liquidity, and size are going to matter as well, right? You know, if your most favorite position is a small cap, international stock, that's not going to be your biggest weight in the portfolio. Now, you may have a meaningful overweight in it, but certainly for risk reasons, you're going to want to adjust. You're going to want to think about other things than just purely fundamentals and valuation.
Oh, I love that. So let's talk about, you run a multi-manager platform essentially, where you've got a lot of portfolio managers that work for you, and they report to you and you oversee them. And I'm always fascinated about this process because from a diversified standpoint, you get diversify yourself on multiple levels, A, from the selection of securities in the portfolios, but B, also on the talent that's the managers that are managing the portfolios for you.
Right.
What are some mistakes that you see people make with respect to portfolio management, and they're at the helm? I'll stop there and then I'll ask you the next question.
Yeah, I mean, I think as we talked about the mistakes, certainly I think we talked about knowing where your bets are, right? I think that's a mistake people can make, and that they don't appreciate that, I have this huge exposure to, something that maybe I hadn't clicked in, but I have a utility portfolio and I have all the growthy or high quality names, and I don't have any of the value names, right? And that can be a legitimate fundamental point of view, but you better know you have it, and you better be, if you're all in one way, right, and all of a sudden value captures a bid, you're going to get hurt on it. So I think it's, first and foremost, it's sort of understanding where those bets you're making are. I think there's classic behavioral economics mistakes that we all make that I think I'm always trying to make sure that my portfolio managers are aware of, and when I'm running a portfolio that I try and be aware of. So what are some of those? There's sort of a recency bias or confirmation bias, right? Where people get excited or amp up names because they're hearing a lot of positive news, or they heard something very recent, right? Well, that may be a small piece of news versus what's going to affect the overall story, but you can see that creep in, right? The sell side starts to get excited about a name, and it's amazing how much that can sometimes raise the confidence level of the analyst or the PM in terms of what they want to do with the stock, wanting to buy the stock. You can see people anchor. They anchor around old ideas. They anchor around stock prices. I think this is something both institutional investors do, and I think it's something that retail investors do, which is, it doesn't matter where you bought a stock, right? What matters is where it's trading today. But it's amazing the psychology of, someone buys a stock at $20 and you tell them and they decide they sell it at 23, right? They have that's a much easier decision than selling it at 17 when they have a loss. But it doesn't matter. Our portfolios are getting marked to market every day. But I think you sort of see that with people, or, stock goes down a little bit and they're like, well, I'm going to wait to sell it until it gets back to where I bought it, right? That's a nonsensical decision, right? Where you bought it doesn't matter. So I think there's some of that. I think the last one is just, is the herd mentality. I think markets and investors will naturally want to sort of go with the herd, and we naturally get confidence from the herd. What I always tell my team is, if you're in the boat, you don't all want to be on the same side of the boat, right? If everyone's in the rowboat and they're on the same side, the boat's going to tip over, right? And so, really, I'm not saying you can't be. I'm not saying there's situations, right, where being on the same side of the boat isn't a good place to be, but you just better be darn careful to know what you're stepping into, right? Because if that boat starts to tip, everyone's going to get burned. And look, we see that all the time in markets. And I guess the last thing I would say, and it's more for the retail investor, is don't jump on the boat unless you know where the boat's going, right? I think, we all have this tendency to want to jump on the next big thing or the thing that's working, whether it's crypto, whether it's meme stocks, whatever. And you may get lucky and it may work in the short term, but in the long term, it's probably not going to work out for you.
I love that. So this is the first time we meet, the first time we're speaking, but it's amazing how many parallels. I mean, in this book, I literally talk about just about everything you said and then some. It's uncanny how many things in common there are. So people are people, right? The emotions sometimes cloud the judgment. So they make emotional decisions, not rational decisions, which is the basis of my book, teach you how to make rational ones. With the cognitive biases, when you recognize those in managers, what do you do gently to bring it to their attention and correct that behavior, if you will?
And we try and rely on data, right? So if I can go back and establish a pattern of where they've done this before, where I can pull out specific examples and say, we talked about this one 6 months ago, or, here's a list of where you're selling and where things are going. I think, that's one of the big things that's changed a lot in our business and in the world in terms of being able to collect data and look at stuff. And so I think people are naturally going to be defensive and resistant when you come in and say you've got a bias against this, no matter what we're talking about. But I think if you can have a level conversation with them and try and bring them data and evidence of it, they may still push back on you, but it'll be in the back of their mind, and hopefully it helps them the next time around to not make the same mistake.
I love that. So we talked about the mistakes. What about some timeless lessons you've learned along the way, and or timeless, good things that people do, the portfolio managers or just people?
Yeah. So, I'd certainly say, timeless lessons is to avoid that herd mentality. I think it's one I'm always having to remind myself. Thematic investing. People can be dismissive of thematic investing. I wouldn't run a whole portfolio on thematic investing, but I think you have to recognize it, that it really can work and really can lift stocks and can be a good place, not only to try and participate on occasion, but also to be cognizant that it's happening. And if something starts to catch that theme, right, it's not, the stocks are going to work, right? And you better not try and fight it. And, you look at the work from home stocks when we got during the pandemic and just sort of the meteoric rise that we saw there. We do a lot in clean energy, and clean energy has had a difficult last, 12 or 18 months. But if you go back to around when the Biden got elected, right? I mean, that was a tremendous thematic trade, right? And if you were able to sort of capture that and see that, there was a lot of money to be made. So, I think thematic investing is an interesting approach and something that, again, our portfolios aren't anchored on that, but I think it's something that, you want to keep in mind. Valuation is not a great anchor. I think a lot of times analysts, all of us sort of rely on valuation. Well, it's cheap and I'm going to buy it, or, I got to sell it because it's too overpriced. But stocks will not often react to valuation, right? It will take a long time before valuation will cause a stock to go up or down, right? If the company is running well and doing the right things and there's good momentum, people are just going to keep justifying the valuation, right? And the same thing where you buy something because you say it's totally washed out, it can't possibly go any lower. It can still go lower, right? You've got to find that catalyst. So it's usually more a catalyst than just the pure valuation that I think will drive something away. Understanding the macro, again, we're fundamental investors and we rely on that. But I think if you're not paying attention to the overall macro, that can really get you into trouble. I have the luxury in my job of being able to spend a lot of time on the macro and, talking and reading smart people and trying to get a sense of it. And I really try and, work with the PMs and all the analysts to at least sort of pass on some of that knowledge or some of the stuff that I'm hearing. And I think it can be helpful, right? Yeah. Look at inflation. If you didn't have the inflation trade right this year, it's been a really rough couple months, right? You can't, there's certain things you can't fight and you got to be aware of them. So, I think, again, we're not a pure macro shop, we're a fundamental shop, but I think you've got to make sure that you have the sort of macro picture sitting on your shoulder and just be aware where it's going to help some of the names in your portfolios or where it may work against you, right? And the last thing I would say are the technicals, but we've touched on those that I think they can be valuable and you should use them to your advantage.
Yeah, I fully agree. It's almost like a toolbox. Why only use a hammer when you can use a screwdriver or whatever else you want to use as well? I love that. So we spoke about lessons, advice. You've been very accomplished in your career, Goldman Sachs and Harvard and so on and so forth. What advice could you give yourself, your 20-year-old self, your 30-year-old self, would you give the audience as far as leadership advice, mistakes not to make, so on and so forth?
I'm sure there are a lot of lessons I could give my 20-year-old self, but I think, you know, when I think about sort of personal advice, it's working hard, and it's you know, listening to all different types of peoples and opinions, right? I think you, especially as you get into this business, you develop your sort of own process and your own way of looking at things. But there are a lot of smart people, and there are a lot of people out there that have made money in a lot of different ways. And it's easy to be dismissive of it, but I think you can also learn different ideas, and you know, it's expanding that toolbox. It's some of the things that we've talked about that you know, I would just continue to try and keep encouraging myself, and hopefully I'm better at it today than I was 20 years ago, of, you know, just keeping a very open mind and listening to stuff. And, you know, it's not stuff you necessarily have to agree with, but I wouldn't just be dismissive of it. I think this is a humble business, and you want to try and stay humble in it, right? I mean, you know, this isn't a business. It's not quite trying to hit a baseball where you're only going to do it successfully 1 in 3 times if you're good. But, you know, I think if you're hitting, you know, if you can get a 60% batting average in this game, you're going to do well, right? If you're right more than you're wrong, you're going to generally do well. And so, you know, don't sit there and try and think that you have to be perfect, right? You're not going to be perfect. The market is too difficult. It's too volatile, and you can't beat yourself up, and you got to keep trying to learn from your mistakes. So, you know, I think the other thing I'd say from a market perspective is, you know, markets are not perfectly efficient. I know there are academics out there that'll argue that it is efficient, but, you know, stocks do get mispriced, and you can make money on that. However, they can stay mispriced for the short term and even for the medium term, and some may even say sometimes for the long term. And you got to be respectful of that. But I think if you do really good work and understand the situation, and stay focused and consistent, you can find stocks that are undervalued and make good money in them.
Yeah, I couldn't agree with you more. I have a whole section devoted to the efficient theory of not being true. How do you justify Buffett's returns, or Paul Tudor Jones, or any of these people that are decade over decade over? It can't be luck, right? So yeah, I fully agree. Well, David, this has been an absolute pleasure. Thank you very much for all the wisdom that you've shared with us, and for your time. If there's anything else that you'd like to share with the audience before we wrap up, please feel free. Otherwise, thank you so much for coming on the show.
No, well, I really appreciate you having me. It's great to have the conversation, and you know, I think markets are a lot of fun and a great career, and you know, love talking about them. So thank you.
Love it. Thank you so much, David.